Welcome everyone to this second session in which we're going to be talking about central bank objectives. At the beginning, the title was Central Bank Objectives in a Post-Crisis World. I wrote here Central Bank Objectives in a Crisis and Post-Crisis World, since we are post the global financial crisis, but we are into a new crisis of unprecedented nature. So in my role as chair, what I will do is I will introduce the speakers very briefly, since they are all very well known. First, Willem Buiter will be talking. Secondly, Marcus Miller. And then thirdly, Martin Helwig. I'm following the order that was given to me by Angus. And thanks to Angus, Ekaterina, and Richard for providing this Zoom platform in these challenging times. And then after the presentations, we will conduct a Q&A, and I will pose a couple of questions. So you can go into the next slide. It has this slide. You can go back to the previous slide. It has the three central banks. So the first one, just back to one, it has the picture of the three ones that will be discussed more significantly today. The picture of the Fed, of the Bank of England, and of the ECB, which will be the three ones that, they will be mentioned to other central banks, but the ones that will be discussed most intensely and deeply in the presentations. So just this slide just goes a little bit on something that we all know very well, which is the evolving nature of central bank objectives, as well as the evolving nature of central bank functions and the relationship between objectives and functions in order to start the discussion. So, we all know that central banks were not, at the beginning when they were not created to conduct monetary policy and banking supervision. They were created to provide finance to the government. And I think it's important to keep that in mind in the light of many of the discussions that take place now, particularly with the ECB, where we have a centralized monetary policy and decentralized fiscal policy, and where there are two views which have been put to the test this week with the Austrian central bank governor or participant in the executive board saying that, that we had reached the limits of monetary policy. After all, we go back to this old function of central banks. And if you can just put briefly the cartoon into the next slide. So that's the fatal embrace. This is a cartoon that was from the 18th century and which really remains very vivid in the background of what central banks do. Are they really entering the domain of fiscal policy? Charles Goodhart has written that most central bank actions have fiscal consequences, directly or indirectly. But this fatal embrace is really at the root of many of the discussions that take place, particularly at the level of the ECB, Governing Council and Executive Board. So though it was the first rationale and the first objectives of central banks to finance the government needs, it has never gone away completely. It always looms in the background when one talks about central bank independence and the economic test of central bank independence, which is not to finance government deficits. So back to the second slide. So this is just a cartoon, so the previous slide. So most of the central banks that were created in the 19th century in Europe, like Bank de France, Banco de España, Banco de Italia, they were created as typically private central banks that were granted the privilege of issuing notes and financing the government needs. So it's not that there was nothing in between the 17th century and the 20th century. Many central banks also in the developing world were created, some others in the 20th century. Why I put the Federal Reserve System is because the rationale for its creation, its primary objective, was in response to the banking crisis of the famous banking crisis, the Morgan crisis, another crisis at the beginning of the 20th century when the US was an emerging economy and suffered, therefore, the banking crisis that emerging economies always suffer. And the rationale for creating the Fed was mostly a response to banking crisis and lender of last resort role via the discount window lending. As we all know, the monetary policy responsibilities of the Fed were only added in the 1930s. So the primary objective was that. Roll forward, Bundesbank 1957, I put monetary stability, price stability is not the only central bank or the first one that had monetary stability, but it became the bastion of what we know, the Tinbergen rule, the one agency, one objective, one function. So I call it the Bundesbank model because it is the model that inspired the ECB in 1999 again, monetary stability at the primary objective. And Article 127 of the treaty says very clearly, and I will read it, that the primary objective of the European system of central banks shall be to maintain price stability, exactly like the Bundesbank. And then it says, and this is quite important in the current debate with Madame Lagarde and some of the challenges that we're facing, without prejudice to the objective of price stability, the ESCB shall support the general economic policies in the Union with a view to contributing to the achievement of the objectives of the Union as laid down in Article 3. Article 3 then talks about the internal market. So the evolution of the objectives in the 20th century was characterized by this Bundesbank model. Roll forward into the 20th century, the global financial crisis is a rediscovery of the twin mandate of central banks. The twin mandate, not in the Fed law case, in the Fed, as we all know, the law says that the Fed has monetary stability, growth, employment, as well as financial stability, or the stability of the banking system, which has now been expanded post-Dodd-Frank. But the consensus that we had for most of the second part of the 20th century of a price stability-oriented monetary policy, the central banks should be independent in the conduct of a price stability-oriented monetary policy, has now been broken, and central banks have expanded mandates. Post-GFC, financial stability has been added by legislation in the Bank of England, in the Fed. In the ECB, we have, I think, Marcus will be talking about it later, or Martin. We have a particular arrangement which we can discuss in the Q&A with the establishment of the SSM and the governance structure, which is peculiar. Just to say that financial stability relies on many instruments, lender of last resort, supervision, one can argue, in addition to monetary policy, fiscal policy, involves other authorities, not just the central bank, the treasury, other supervisory authorities, and coexist with other goals. And really, the current crisis, and even before the current crisis, the debate has expanded. Should the central banks, in the pursuit of their mandates, also try to achieve the objective of sustainability, climate change, and now with the coronavirus crisis, the fiscal impact and the coordination again between the fiscal and the monetary domain? So just forwarding to the last slide, so we passed the cartoon 3 and then we go into 4, just to say that all these functions has been evolving and continue to evolve in the light of the objectives. And I'm not going to say very much because I'm the chair, but note issue. I mean, I'm doing together with other scholars as part of the Rebuilding Macroeconomics project, a research project on the future of money. And with the advent of central bank digital currencies, this whole issue of note issue has a new dimension. Government bank always looms in the background. The ones that are underlined are the ones that have greater importance in the context of the post-global financial crisis, monetary policy, conventional and unconventional, which I know will be discussed by both Willem and Martin and Marcus. Microprudential supervision and regulation, just to remind ourselves that it's not a necessary nor exclusive function, and the pendulum keeps on going backwards and forwards in and out of the central bank. Now the pendulum is in the central bank. Macroprudential supervision, one of the new things that the global financial crisis has made mainstream. Bankers' bank, operation of the payment system, and lender of last resort. And then I will not just management of gold and foreign reserves. These are functions that central banks may or may not do. Conduct of foreign exchange operations, debt management, exchange controls, development tasks. And the most novel function in some central banks is when central banks also have, like the Bank of England, resolution task. So are central banks doing too much? Do they have too many objectives? And with these two questions, I open the floor to our first contributor to the panel, who is Willem Buiter. So thank you very much, Willem.
I changed this presentation quite radically from what it was initially to focus on what key central banks are doing today faced with the coronavirus crisis. Let me see, where's the page up and page down here? Okay, I'm getting in my own way. Let's minimize this. Okay, very good. Operational independence started with New Zealand, and it's still in the late 1980s, 1990. It was introduced during a period that the role of central banks was de minimis, where central banks, when they gained operational independence, like the Bank of England, gave up all the supervisory regulatory functions. But of course, during the great financial crisis, it all came back, and central banks pursued a host of supervisory, regulatory, and financial stability functions. One aspect of financial stability that a central bank will never be able to get away from is act as a lender of last resort, and in an economy with market intermediation, market maker of last resort. Whether they can go beyond that and be actively involved in the solvency aspects of financial stability is something I very much doubt. So I favor what some of the earlier speakers this morning advocated, return to rather narrower central banking, meaning the pursuit of macroeconomic stability, price stability or a dual mandate, and then a de minimis financial stability, of a role of market maker of last resort, lender of last resort, where anything involving fiscal, quasi-fiscal dimension has to be done explicitly, jointly with the fiscal authority. This slide here shows the extraordinary behavior of interest rates since the 80s. And here it shows the even more extraordinary behavior of interest rates going to schmelzing since the late Middle Ages. We are likely, according to this approach, to have central banks that are effectively unable to fulfill one of their narrow roles, that of traditional stabilization policy, the pursuit of price stability, or a dual mandate, because they are constrained by the effective lower bound. So until and unless we get rid of cash or introduce a variable exchange rate between cash and deposits, right, central banks in much of the world effectively have become powerless to pursue their macroeconomic stability mandate. They still have a very important financial stability, lender of last resort, market maker of last resort mandate. Onward. This policy rate picture, of course, is hopelessly out of date. I couldn't update it. Everybody except China is now just about at zero, with the Bank of England lingering at 10 basis points for its policy rate. The explosion of the balance sheet is a reminder of the growing fiscal and quasi-fiscal role that central banks have played since the beginning of the great financial crisis, a role that has been especially crucial in the euro area. Now, let me get on with what central banks can do today to deal with the economic and financial consequences of the coronavirus pandemic. The short answer is, on their own, not very much. We deal with a real economy shock, both demand and supply shock, which has been aggravated, I think appropriately, by policies to get the virus under control. And this real economy shock has financial consequences that could further destabilize the real economy if we do not address these financial consequences. And the central banks have been in the forefront of minimizing the financial consequences of a real economy, aggregate supply shock of the coronavirus crisis. Fundamentally, though, central banks only can do the high-frequency liquidity end. Legitimately, the state, that means the Treasury, will ultimately have to take the true fiscal decisions, including, very importantly, the extension of credit guarantees to corona's impact on firms and households. Let's see what have the banks done. Traditional central banking stuff: cut bank rate, Bank of England, introduce a new term funding scheme, increase the holdings of UK government bonds, expand on QE by another 200 billion, and provide more room for bank demand. If somebody could put their steps on mute, that would be good. By reducing the countercyclical capital buffer, but fundamentally, the important decisions are. Sorry, let me just go back. From a financial stability point of view, the new term funding scheme, which only makes sense if it is backed up by an implicit credit guarantee from the Treasury, and indeed how much this Treasury has, as of the 19th of this month, yesterday, introduced the COVID-19 corporate financing facility, with the Bank of England acting explicitly as an agent that is legitimate of the Treasury to purchase commercial paper and provide funding to non-financial businesses. And I assume that should push comes to shove, this funding is provided with a de facto guarantee, credit guarantee from the Treasury. And there has in fact been 330 billion package of loan guarantees for the UK businesses already extended. The Fed, again, a whole range of traditional monetary policy actions, which do rather little, I think, on balance, to address the fundamental credit and solvency issues faced by households that have lost income and corporates that have lost revenue as a result of the corona crisis. Beyond these conventional monetary policy measures, the Fed has, I think very importantly, rediscovered that the world doesn't end at the east coast of Long Island, and it has reinstated the swap lines. This morning, it expanded the number of beneficiary countries by another 9. The federal government, I think, will ultimately end up providing not just fiscal support, but also credit guarantee support, possibly through the Fed, to financially challenged corporates. The ECB Euro system, again, a whole range of monetary policy actions. In this particular case, however, the case of fiscal dimension is so much more blatant because of the redistribution among the key shareholders of the ECB, the national sovereigns, that is potentially involved in an extension of credit through the purchasing of sovereign debt. So the fact that another 750 billion of asset purchases was added on the 18th of March, in addition to the 120 billion added a couple of days before that, we're going to have a massive expansion of the quasi-fiscal exposure of the ECB, an exercise which is perfectly understandable, but I think is entirely politically illegitimate, because this is a task that should be fulfilled by explicit fiscal commitments by the member states, possibly through the ESM, but not through operations that are made to look like open market operations and financial stability operations, but are in fact most likely, in the case of a number of countries, think Greece now and Italy, sovereign solvency and bank solvency sustaining operations. Again, it's the governments that have to do the heavy lifting in the euro area, as they do in the UK and in the US. The German government has already announced 500 billion worth in loans to companies, most of these provided through KfW. Again, slightly dishonest, the State Development Bank, but I think everybody recognizes these for what they are. These are sovereign guaranteed credit extended through the intermediary of KfW. The French government extended 300 billion euros worth of French state guarantees for bank loans to businesses. And they were hoping for $1 trillion worth of guarantees from the European institutions for the entire EU. This, of course, hasn't happened yet. The Spanish government, the Italian government, and all of them will, I think, ultimately end up underwriting the fundamental solvency problems that are faced by their financial institutions and or by their corporates, depending on who takes on the overall exposure. In Japan, very little was done in response to this crisis thus far. Now, what more can central banks do? Very little on their own. Financial support for households and firms will have to come mainly from the state through tax cuts, explicit cash transfers, or credit guarantees. Direct transfer payments to firms and households should be made by the state, not by the central bank. They can be made by the state through the central bank if it is an open and transparent helicopter money job, where the treasury is the fiscal leg and the monetary leg is provided by the central bank. In the euro area, this would require a change in the treaty. Point 5 is especially relevant, of course, for Italy today, because we are likely to see a fiscal rescue of the Italian government before long through an increase in ECB or Banca d'Italia exposure as the Italian government tries to rescue its heavily hit economy from the consequence of the coronavirus. I will stop here.
Thank you very much.